Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. In this week's edition of the class, we're actually going to be talking about Forex correlations, okay? So, this is kind of an intermediate, or you could even call it an advanced concept in trading, because a lot of traders who get involved in Forex trading most of the times don't know what correlations is. And this is one of the things that if you don't know or you don't understand, it could affect your trading, especially if you're trading with discretionary trading strategies. Okay, so it could have an impact on your trading. Okay, and most of the times for those, especially for those who completely do not have an idea about how to use correlations or how to navigate using correlations, this could have a kind of a negative impact on your trading, especially with regards to risk management and all of that. Okay, so before we dive into the class proper, we need to first understand what is meant by the term correlation. Okay, so when we talk about correlations, Forex correlations, exactly what are we talking about? So to give you an example, or to help you understand this better, let's use an example. Let's use an analogy. Okay, so from the word, okay, so let me quickly do a quick Google search here. Okay, let's look for the meaning of the word correlations. Okay, because it's an English word. Okay, so let's do this correlation meaning. Okay, so correlation is a mutual relationship or connection between two or more things. Okay, so I want you to bear this in mind while we go back to MetaTrader. So when we're talking about correlations in Forex, this refers to the kind of like the relationship between currency pairs. Okay, so to help you understand this better, let's assume that you've got your edge. You have a trading strategy that you've back tested, and on the currency pair that you've back tested that trading strategy, you found it to be profitable. You know, even though past performance doesn't guarantee future results, because you've done your due diligence, this gives you an edge in the market that since the strategy has shown you that it's proven to be profitable in the past. Okay, but the thing is, if let's assume that you backtested that particular trading strategy on the Euro USD currency pair and found it to be profitable. Okay, now the thing is, if you were trading with proper risk management, let's say you're trading that particular Euro USD currency pair and you're trading with proper risk management, you're risking 1% of your account's balance on each and every trade you took. Okay, that's all well and good. But let's say you wanted to expand the currency pairs you trade. So instead of just sticking to the Euro USD currency pair alone, you decided, okay, you know what, I'm going to trade, a handful of the majors. So I'm going to trade the Euro USD currency pair, and I'm also going to be trading the GBP USD currency pair. Now, on the face of it, this might look like a good idea, and it might be. But the problem is, if you're trading them with the same approach, if you happen to be long or short on the Euro USD and the GBP USD at the same point in time, simultaneously, then you're just doubling your risk on the trade you're taking. Because if you take a look at how the Euro USD currency pair and the GBP USD currency pair move, they almost mimic each other. They are, and this is what we refer to in Forex terms as they have a positive correlation. So when the GBP USD, for example, is showing you a downtrend on the 1 hour time frame, for example, it is very, very highly likely, because they are positively correlated, that the Euro USD is also going to be showing you the same thing. And this is exactly what we're seeing on the chart. Just pay close attention to what we have. This is the 1 hour time frame of the Euro USD. And because the Euro USD and the GBP USD are positively correlated, if the GBP USD is going in a downtrend, the Euro USD is also highly likely to be moving in that same downtrend. That is not a bad thing in and of itself. Where the problem arises is if you're trading these two currency pairs simultaneously and you happen to be short on the Euro USD, for example, let's say you shorted somewhere around here with a stop loss around here, and you're aiming for, a simple 1:2 risk to reward ratio. Just to make this example simple for you to understand. The problem is, if you also took a short trade on the GBP USD currency pair at the same time, and you are risking the same 1%, you are actually betting on the same side on both of these currency pairs. So even though it might look on the face of it that you're only risking 1% of your trading account's capital on the trade you took, in reality, because you're almost doing the same thing on these two currency pairs, you're actually risking way more. I hope you get this, because the currency pairs are positively correlated. When one thing happens with one of the pairs, it's highly likely that the same thing will happen on the other pair. So if for whatever reason the trade you took decided to reverse against you and move up, if price of the GBP USD currency pair moved up, it is highly likely that the price of the Euro USD currency pair is also going to move up. So if you hit a stop loss on one of the pairs, because they are positively correlated and you're taking the same trade on both of them, it's highly likely that the other trade stop loss on the other currency pair is also going to be hit. This is also a problem even if the currency pairs are negatively correlated. So what do I mean by negative correlation? Negative correlation is when, if the Euro USD, for example, is moving in a downtrend, but then the other currency pair, let's say, just for simplicity's sake, let's say the USD JPY, okay, is going to be negatively correlated with it. And so when the Euro USD is moving in a downtrend, the USD JPY currency pair is highly likely to move in an uptrend, okay, because they are negatively correlated. So if you took a short trade on the Euro USD, and you're risking 1% of your account's capital on that particular trade, and you took a long trade on the USD JPY, even though on the face of it, it might seem that you're taking different trades on these two different currency pairs, because they are negatively correlated, it is highly likely that if price hits the stop loss of your Euro USD trade, because it moved up or it moved down or whatever the case might be, price is also likely going to hit the stop loss of your USD JPY trade, and vice versa. Okay, so the thing is, you don't want to be trading if you can. Okay, if you've got an edge that you've back tested and you've got all of these things, what you want to do more times than not is, as much as possible, you want to trade currency pairs or tradable instruments which have no correlation whatsoever with each other, as much as possible. The reason why you want this to be so is because you don't want to, if you take a trade and you're risking 1% of your trading account's capital on the trade you took, if the currency pair you're trading is either negatively or positively correlated to the other currency pairs that you're trading in your portfolio, then it's highly likely that if you're doing, if you're trading positively correlated currency pairs and you're both long on both of them or you're short on both of them, when stop loss gets hit on one, it's going to get hit on the other. And if they are negatively correlated, if you go long on one pair and you go short on the other pair, then it is highly likely that when price hits the stop loss of one, it's going to hit the stop loss of the other. So you're basically overexposing yourself on all of those trades that you take. But if you traded instruments that are completely uncorrelated with each other, then what price does on one pair is likely not going to affect what is happening on the other pair all that much. So if you're risking 1% on one pair and you're risking 1% on another completely uncorrelated pair, then it's not really going to affect it if price decides to, meander and do whatever the case might be. So you're not basically risking, if you're risking 1% on each one of those uncorrelated pairs, it's not like you're doubling your exposure on the trade. Okay, so, because you're trying to limit your exposure to the market. That's just what that's what correlation is all about. Okay, so now that you understand the logic and the principles behind correlation, let's look at what the tools that will help you to identify this correlation and help you to navigate it like a professional trader. Okay, so we've got tools here. You could do a quick Google search for Forex correlation meter or something like that. Okay, it seems I can't spell today, sorry. Correlations table or something. Yeah, here. If you search this, you're going to be met with a lot of different websites that are going to show you basically the same results. Okay, and as you can see already, I've opened up one from my FX book. You can open the one from my FX book, or you could open the one from Fastbull, Mataf, any one of this. It works almost the same way. Okay, the thing is, if you were to come to the table first before you understood the logic behind correlation, then it's going to be difficult for you to understand it. But if you, like we did now, explain the logic in a way that you understand it, then using the table is just going to help you identify currency pairs which are likely, uncorrelated, so that if you're trading both of them simultaneously and you're risking the same thing on both of them, you're not overexposing yourself to the market. in essence, that's just what we're trying to do with this correlations, okay? So let's look at a couple of examples, okay? And this you could see is showing you with the heat map, the positive correlated pairs, all of these things with the time frames and all of that. But I feel the one from my FX book is much easier to read, okay? So what do we have here? You can see on the left-hand side of the table, we've got the currency or the currency pair, okay? And towards the right-hand side, we've got other currency pairs, which are compared to that. The correlation of those pairs are compared to the currency pair on the left. So, in essence, let's start with the first one here, which is the AUD card currency pair. So you can see that the AUD card is here, and we've got the AUD card here, which is simply, just telling you it's the same currency pair against the same currency pair. So how correlated is it? Obviously, because it's the same currency pair, it's 100% correlated, because if AUD card against AUD card was compared and it moved up, it's obviously going to move up. It's just the same thing, comparing apples to apples, okay? So it's always going to be 100% correlation. But when you compare the AUD card with the AUD JPY, you could see that this currency pair is actually correlated about 90.8%. Okay? So this would mean that if the AUD card, for example, is moving up, then it's highly likely that the AUD JPY currency pair is also likely to mimic that movement as well. So let's take a look at this, okay? Let's go to the AUD card currency pair. This is it right here. Okay? And this is the 1 hour time frame. So you can see it's moved a little bit. It moved a little bit up, and then it's kind of like in the range, kind of, okay? But then when we compare it to the AUD JPY, you'd almost see that it's almost the same thing, almost, because you can see it also did move up, but then it's actually going down a little bit now, just like we saw on that other pair. So it's kind of doing the same thing. And this brings the question back. If you took, for example, a short trade on the AUD card currency pair, because you saw that it moved up, it had double tops, and it was struggling to break above this resistance, for example. And let's say you saw the formation of this bearish engulfing at this resistance area, and you decided to short this pair with a stop loss above this. Let's say you're just using a simple price action trading strategy, and you're aiming for a 1:2 risk to reward ratio trade. So let's say, for example, you took this trade at the close of this candle, and then your stop loss was above here, and you're going for a 1:2. This would have easily hit your profit target, which would have been a good trade, okay? But what about this? What would it look like on the AUD JPY currency pair? You can see that it actually went up, also had resistance. This is kind of like a double top that formed here. And so if you are taking this trade here with entered around at the close of this bearish engulfing candlestick after this double top was formed with a stop loss above here, let's say, somewhere around here, with a stop loss above this, okay, your trade wouldn't have hit stop loss. It would have been, almost it hit 1 hour, and then now it's almost back at break even. So in essence, you can see that the trade that you took on the AUD card moved to hit your profit target, and the trade you would have taken if you are taking these two trades, if you're trading the same currency pair, it wouldn't have hit your stop loss, and it's also already obviously in profit. It's because this two currency pairs are positively correlated, so they almost did the same thing. But what if the trade you took on the AUD card currency pair would have reversed against you and hit the stop loss? Because they are kind of positively correlated, about 90%, then this would have also very highly likely for it to, it would have been very highly likely for it to have hit your stop loss as well. Okay? So now that we've gotten this example out of the way, let's look at a comparison of a currency pair that has a very low, very low correlation with the AUD card. In this case, this would be the one on the extreme end here, which is the USD JPY currency pair. So because they are the correlation between them is almost non-existent, because it's only a correlation of around minus 8.5%, it's highly likely that when the AUD card is doing its thing, the USD JPY is also going to do its thing. They're almost not concerned with each other. And this is the type of correlations that you want to trade in your portfolio. Because when you're trading the AUD card and you're trading the USD JPY currency pair at the same time, when news, for example, affects the USD, it's likely not going to affect the AUD card all that much. Okay? So let's take a look at what the chart would look like for these two. We've already seen what the AUD card the card AUD card currency pair looks like, okay, the 1 hour time frame. So price was kind of like in the range, okay, went up, hit resistance, it couldn't break above it, came down a bit, tried to break it again, failed to do so, and then price is just going down again. Now, what does it look like on the USD/JPY? You can see that the USD/JPY is in a clear uptrend on this time frame because it has been forming what? Higher highs. Remember our market structure? Higher highs and higher lows. Higher highs, okay? Higher lows. Higher highs and higher lows, okay? Obviously. So we had a little bit of a liquidity sweep or whatever you want to call it here. But then overall, we've just been forming higher highs and higher lows, okay? So this is clearly, when you look at this, it's clearly in an uptrend. Clearly in an uptrend. In fact, I'm going to leave this drawing on, and then we're going to draw the chart of the AUD card. And you can see the AUD card was just stuck in the range, okay? But the USD/JPY is just been going up. They're almost completely uncorrelated. So I hope you get the importance of this understanding correlation in currency trading. Why is it important? The reason is because you don't want to overexpose yourself. If you took a short trade on the Euro USD currency pair, for example, when it was in this downtrend, okay? Let's say you saw this, okay, price was going down and then it hit resistance here, it came down, failed to continue going up and hit resistance again, leading to the formation of this bearish engulfing candlestick, for example. Let's say at the close of this candle, you took a short trade with a stop loss around above this resistance area, okay? Which is a good trade. Let's say you took this trade risking 1 to 2. Your stop loss is here. You're aiming for a 2% profit target or 3%. It would have easily hit your profit target. Let's check for the same thing on the GBP USD currency pair. So remember, they are almost doing the same thing simultaneously. It hit resistance, came down, all of this. And let's say you took this trade also on this pair, okay, at the close of this bearish engulfing candlestick with a stop loss here, aiming for a 1:3. This is a good thing if you look at it in the sense that, okay, you took this trade and this trade would have hit your profit target. So both of these trades, okay, would have hit your profit target. In this case, it's a positive reinforcement. It's a positive thing because if you're risking 1 to make 3, that's you're trading with a 1:3 risk reward ratio on both of these pairs. Each one of them would have given you a profit of 3% and you would have made profits on both of these trades. But what if, just what if, you took this trade on both of these pairs and then instead of moving in your direction, all of them immediately moved against you? You would have hit your stop loss on both of these trades at the same time. And this is what the problem with correlation. If you're trading highly positively correlated or negatively correlated assets, it's almost as if you're taking, instead of, if you would think that you're risking 1% on each one of the currency pairs that you're trading, but because they are highly positively or highly negatively correlated, it's almost as if you're just doubling your risk on both of these trades. So if you took a short trade on the Euro USD at the same time that you took a short trade on the GBP USD, and you're risking 1% on each one of those currency pairs, it's almost as if you took one trade on the USD, you understand, and you're risking 2%. Because if your stop loss gets hit on one of these pairs, because they are highly positively correlated, it is very, very, very likely that the stop loss of the other trade is also going to get hit. And that's what we don't want. We want to trade assets where if we're risking 1% on one pair, and we're risking 1% on another pair, we want them to be as highly, uncorrelated as possible, so that just because news affects one of the pairs and it hits your stop loss, the other pair is also not going to, just out of the blue get affected by that same news. And that's why I showed you with the example of the USD/JPY and the US AUD card, because they are almost completely uncorrelated. You can see that when the AUD card was just, bouncing off of levels of horizontal supports and resistance or whatever, USD/JPY was clearly in an uptrend. So it's almost as if you risk 1% on both of these pairs and you took a trade at the same time on both of the pairs, you're not actually overexposing yourself because they are uncorrelated. Or let's say they are highly uncorrelated. Okay? So that's what I want you to understand. And just like positive correlation affects the same pairs of the same feather, for example, like the Euro USD and the GBP USD. What I mean is when the GBP USD or the Euro USD is in a clear downtrend, obviously, the other one is also going to be doing the same thing. There is also negative correlation. So if the Euro USD is in a clear downtrend, because the USD is the quote currency in this pair, if the USD is increasing in strength, this pair is going to go down. It's going to be in a downtrend. But also, pairs like the USD JPY, which have the USD as their base currency, when the USD also increases in value, they're also going to go up. Okay, so they're going to go high. They're going to increase in value. So just because the Euro USD or the US or the GBP USD and the USD JPY are negatively correlated, what I mean by negatively correlated is if the Euro USD goes down, the USD JPY is going to go up. Okay, so just because they are negatively correlated does not mean that if you're taking a short trade on the Euro USD or the GBP USD and you're taking a long trade on the USD JPY that you're taking two different trades. Actually, no. Because they are negatively correlated, highly negatively correlated, this is also almost like this taking the same trade on one currency pair, because you are shorting when you're shorting the Euro USD, you are betting against the euro and you're betting in favor of the dollar. And when you're going long on the USD JPY currency pair, you are betting against the Japanese yen and you are betting in favor of the USD. So if the USD was to lose its strength in the market, your Euro USD trade is going to hit its stop loss because it's going to go against you. And the same thing is also likely going to happen on the USD JPY. So just because when the Euro USD goes down, the USD JPY is going up, does not mean that if you take a buy trade on the USD JPY and you take a sell trade on the Euro USD, that you are doing different things. No, you're almost doing the same exact thing. So if you're risking 1% on a trade where you're shorting the Euro USD, and you're risking 1% on a trade where you're going long on the USD JPY currency pair, you're almost taking the same trade also. Okay, because if the stop loss of one gets hit, the stop loss of the other is also highly likely to get hit. Okay, so you want to trade currency pairs which are highly uncorrelated as possible. Let's look for another example. Okay, let's look for another example. So we've got, let's see, AUD JPY. And you can see that the AUD JPY currency pair is somewhat correlated with the USD JPY. But let's see which other pair is it not too correlated with the USD CAD. So let's take a look at this, okay? AUD JPY, USD CAD. Now, when we look at the chart of the AUD JPY, where is it? Let me see, do I have it here? Yes, I do. So I'll just drag it onto the charts, and you can see this is what it did. It's almost like it's in a range, okay? It's been moving kind of like in a downtrend, but then it broke above resistance, and now it's kind of moving like it's in an uptrend. It's kind of choppy, okay? But what about the USD JPY? You can see that the USD JPY is in a clear trend. And this, remember, this is the kind of moves that we want to see. Because the idea here is that you can see that the AUD JPY is kind of like in a range. So if you were to, for example, take a short trade on the AUD JPY, AUD CAD. Was it the AUD CAD or the AUD JPY? Okay, I think I'm mixing the two of them. It was the AUD JPY. So let's say, you saw kind of like a resistance on the AUD JPY somewhere around here. Price came here and it got wicked, okay, it got rejected. And then when price tried to break above this resistance area again, it failed to do that. So let's say at the time where, this bearish engulfing candlestick got formed, you decided you were going to take a short trade on this pair. So let's say you shorted here with a stop loss above the resistance, aiming for a 1:2. This would have been a good trade to take, okay? But then since we took a short trade here, let's assume that we wanted to see the opportunity that we had on this pair, which is not as correlated with the AUD JPY as much as possible. And you can see on this pair, we would have not even been thinking about going short at all, because if we were trading based on price action, you can see that here we had something that looked like kind of like a support. So price was kind of like in a downtrend, but then out of the blue, okay, it came here, it failed to break below this support area, and then it got wicked, it got rejected. And so we had this lower high, but then eventually price broke above this high. Okay, it broke above it, and then when it retested it, it couldn't keep going lower, and so we had the formation of this bullish engulfing, kind of these two candles completely engulfed this bearish candle. So let's say based on the price action we saw here, you decided you were going to take a long trade at the close of this candle with a stop loss somewhere around here. So if you are taking this trade here, also aiming for a 1:2, this would have been a good trade. You would have been short on the AUD JPY and long on this pair, but they were completely almost uncorrelated. So if it so happened that after you took this trade, price just hit your stop loss, just because it hit your stop loss does not mean that there's a highly likely possibility that the USD card is also going to hit your stop loss if maybe the same news event or the same news release got released into the market, because they're highly, uncorrelated pairs. And that's what you want to do. So just because you are practicing proper risk management, meaning you're risking 1% of your trading account capital on each trade you take, just because you're doing that, if you are not trading pairs that are completely uncorrelated or highly uncorrelated, let me not say completely uncorrelated, but highly uncorrelated, that would also, this is a common mistake that newbies and beginners tend to make, because they'll tell you that I'm only risking 1%. But then if they tell you that they're only risking 1%, but at the same time, they're trading currency pairs that are highly positively or negatively correlated. And so even though they're risking 1% on each one of those trades they are taking, because they're taking almost the same trades on the other currency pairs which are positively or negatively highly correlated, it's almost as if they are doubling or tripling the risk they're taking on those positions. And so it's not just risk 1% of your account capital on the trade you are taking, but you also need to factor in how the currency pairs you are trading are correlated with each other. Because if you don't do that, then you might end up doubling your risk on the trades that you're taking without even knowing that. Okay? So I really hope you got value in today's class, because this is one of the concepts that a lot of traders don't really understand, especially newbies. Okay? They'll tell you that I'm doing proper risk management, I'm doing this, I'm doing that, but because they are trading all of these pairs at the same time simultaneously and they don't know much about correlations, then they're almost doubling or tripling their risk without even knowing it. Okay, so please learn from this and avoid these mistakes at all costs. And if you want to use the tools, just come to Google. Okay, it's not hard to find. Just do a quick Google search for Forex correlations, and there are lots of, just like I showed you, there are lots of them out there that will show you which one of the tools you should use. Okay, so this is the one from, I think this is the one from Fastbull. The one I used for this example in today's class is from my FX book. Any one of this would work. Okay, you just need something that would show you how correlated they are. Or if you want to save yourself this trouble, okay, you could just trade one currency pair. So if you're trading, for example, I trade the GBP JPY, and most of the times I don't even look at other currency pairs. I just don't. It's a good thing, okay, to have currency pairs other than one that you're trading, if you want to do that. The positives are, when you're trading only one currency pair like I do, okay, and you're trading something like a swing trading strategy, then it might take you a couple of weeks to find trade signals. And if you're in an extended drawdown, some drawdowns can last for a couple of months. So if you don't want to have to sit through all of those, type of drawdowns and all of those things, then you can supplement the pair that you're trading by trading other currency pairs which are not too correlated with each other. And so when one currency pair is in a drawdown, for example, maybe the other one might not be in a drawdown because they are not correlated, highly correlated positively or negatively. And as a result of this would help you to, kind of reduce the negative effects of drawdowns and losing streaks and all of that. So if you want to, you could trade other currency pairs, but make sure they are not highly positively or negatively correlated. Okay, but if you just don't want the stress, you can just trade one currency pair and call it a day and just focus on it. Okay, and you don't need to bother about all of this. But like with anything in trading, I would implore you to open a demo account, then practice what you learned today. Look at the charts, look at these instruments and these meters and this table, and then look at how it impacts your trading. Okay, and then gauge the thing that you're testing out, gauge it and see how your performance improves and all of that, to see how it improves your trading. Okay, and before we wrap up the class, again, I would like to introduce you to our ITU suite of bots, which are robots which are designed to help you earn while you're learning. Okay, so they are automated trading strategies and expert advisors which are designed to find low risk, high probability trading opportunities for you, and then not only find them, but place trades on those pairs for you with low risk, okay? And with our risk recommendations, if you follow them, they would help you to trade on your behalf and help you start to earn while you're learning, okay? So if you're interested in the bots, please reach out to us on any of our social handles or drop a comment on this video and let us know. And would be glad to help you, assist you, set everything up in as little time as possible. So if you're interested, please reach out to us. And before we wrap up the class, I would like to use this opportunity again to thank you guys for taking time out of your busy schedule to make it to this classes. We really appreciate it, and I hope you've got value in the class. I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your week, and God bless you all. Cheers Thank you.